Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. In this session, I want to bridge from last month's Under the Lens video and recent newsletters where I've been talking about economic indicators and the distortions that we've been witnessing. Most recently, I highlighted the blatant distortions in the January labor report. It certainly isn't unusual for governments to distort their economic reporting, but in the U.S., it has previously always taken a more subtle means through clever statistical games such as hedonics, substitution, imputation, weightings, etc. All of these I've reported on over the years, but this time it is different. Something has changed. I also want to talk about two other stealth games that are going on in parallel. One stealth activity is liquidity. I have previously warned about this and strongly suggested you watch the actions of Treasury Secretary Janet Yellen and not simply Fed Chairman Jerome Powell. More on that later. The other stealth activity is about influencing market narrative through price action. As such, I would like to discuss these subjects as outlined here. The goal of these activities is to buy time for the Fed to achieve basically three needs: hike the Fed funds rate and interest rates to fight current inflation pressures, reduce its bloated balance sheet, and let inflation have time to moderate from the causes perceived to be associated with the COVID-19 supply chain shocks. The Fed is acutely aware that without this being accomplished, the inevitable recession of an overextended business cycle will likely become beyond their ability to manage and stop from raging into another potential Great Depression. I suspect that the Fed has come to fully realize the predicament they have placed themselves in with inflation. Though they are clearly guilty of sticking with the inflation is transitory narrative and not raising rates sooner, it is not completely their fault. The U.S. federal government's fiscal spending topped nearly $6 trillion in 2020 alone. Then it spent another $1.9 trillion in 2021, for a total of roughly $8 trillion in 24 months. That is a lot of inflation loading for the Fed to be expected to react to, especially remembering they were already dealing with the $3 trillion they printed between 2008 and 2014 to combat the fiscal crisis, and then the Federal Reserve printed that same amount in 6 months in 2020, ultimately printing a total of $5 trillion in just 24 months. Who would have thought that printing and or spending $13 trillion, which is 61% of the U.S. GDP in 24 months, would ignite inflation? So what is the Fed's response to all this? Raise rates from 0.25 to 4 3/4, while draining a measly $5 trillion in liquidity from the system? Does anyone actually believe that the Fed itself believe that it can rein in the inflation that was created by printing or spending $13 trillion by raising rates a little over 4% and shrinking its balance sheet by 6%? If you pass an Economics 101 course, you would know better. Every month that the Fed continues messing around, inflation becomes more embedded in the financial system. This is the kind of environment in which crashes can happen. The Fed is rapidly losing credibility, and investors have been suckered into believing the worst is behind them. They poured $1.5 billion into stocks every day in January. So what do you do about it? Well, first of all, the manipulation of government economic data releases has reached a point where even professional houses like J.P. Morgan, Goldman Sachs, UBS, and others are screaming publicly. I personally never heard this happen before. It has become impossible to be an economist or data watcher, and thus strategist, investor, pundit, or analyst in the U.S. The reason is that the seasonal adjustments have made virtually every data set a load of garbage with little relevance to the real world. Consider the latest non-farm payroll number, where the seasonally adjusted print came in at a shocking 570,000, but only thanks to a near record seasonal adjustment factor, which transformed a 2.5 million decline into a blowout gain, which had a profound impact on the market and Fed psychology. Retail sales, which also shocked to the upside, but only after generous seasonal adjustments, which are based on just some Excel modeling and a few political taps on the shoulder, I suspect, converted the traditionally weak January into a blowout month. Then we also have the initial jobless claims report, which once again surprised to the downside, and despite wave after wave of mass layoffs and severances, it magically dropped to 4-week lows, once again underscoring just how wonderful the current administration's economic policies are as they translate into such a great labor market. However, this time it was the largest U.S. bank that is calling the BS on the increasingly ridiculous politicized data that is coming out of the administration. In a note from J.P. Morgan, the bank's economists point to the stubbornly, laughably low initial jobless claims, and I'm using their words, especially when considering directly tabulated reports of layoffs, which in January just hit a multi-year high, according to layoffs.fyi, which I showed in the last Under the Lens video and appears J.P. Morgan are also using. They then politely say that, and I quote, some alternative seasonal adjustments of the initial claims data show some favorable changes in filings from the recent weeks than the official figures, end of quote. A little sarcasm there. JPM is merely echoing Goldman Sachs, which several weeks ago also found that the initial claims are unrealistic and that when looking at credible state-level WARN mass layoff notices, initial claims are far higher. It's not just J.P. Morgan and Goldman Sachs, however, as 3 weeks ago, UBS also joined the fray and showed that yet another data series, job openings, is either intentionally or accidentally inflated, and when you look at third-party data, the real number of job openings is about a third of what the monthly JOLTS report indicates. What is especially funny is that banks no longer merely observe how the data no longer fits, but are making it into a type of personal crusade to expose the grotesque levels of BS emanating from the Biden administration. Case in point, another UBS economist just a few days ago published a report asking, rhetorically, if the non-farm payroll report is overestimating job gains. I could go on with more examples, but I think it was well said by former Fed Governor Kevin Warsh during a recent interview with Larry Kudlow on Fox Business. I mentioned this in the last Under the Lens video, as these examples were just then springing up, as Walsh so clearly stated, and I quote, no major corporation would use data from the BS or Commerce Department, end of quote. He is clearly trying to tell the public something here. He's no longer a Fed governor. But what are they really up to in this concerted push? It is obvious more than just making things prettier than they really are. It is multifold. One, as I've outlined in my newsletters, they had to aggressively tighten the financial conditions index, which were disconnected from what they were doing at the Fed. Two, they had to push out the market's belief in a near-at-hand Fed pivot. Both these were achieved as the surge in the Fed funds terminal rate and rise in the 2-year note show here. But they wanted to do more than that. They needed to push out the market's expectations about the looming recession and current investor sentiment. That is where it gets interesting and frankly more important. I have used these two sequences in my newsletters. One is HOPE, which stands for housing plus new orders plus corporate profits plus employment. The other starts with the 2-year U.S. Treasury note, which the Fed funds rate always follows and progresses to unemployment as defined by layoffs and defaults in the way of bond and credit defaults and bankruptcies. These are a very simplified view of the raft of economic indicators out there, but quite effective if used properly. What is clear to us is the government is not messing with the leading or coincident indicators, but rather the lagging indicators. That is because it can create the most uncertainty and can make economic conditions reaching breaking points much further out, or at least harness investor risk appetite towards taking risk on these. The often invisible and behind-the-scenes Janet Yellen, however, was recently front and center, stating as loudly as anyone would listen, and I quote, "You don't have a recession when you have the lowest unemployment rate in 53 years. End of quote. She is right if the lagging unemployment rate is as she claims it is. I'll come back to that in a few minutes. Before we do that, let's look at the key leading indicators first. The leading economic indicator, LEI. On a year-over-year basis, the LEI is down 6%, close to the biggest year-over-year drop since 2008, when we saw Lehman and Bear Stearns Both go into bankruptcy, and this outside of the COVID lockdown enforced collapse. Housing is quite literally plummeting worldwide as a spike in mortgage rates takes its full toll. An inverted yield curve. The yield curve is as inverted as it had ever been, going back to the Volcker era. Rate crisis, which with current global debt and leverage levels, we have no way of repeating to get ourselves out of the current dilemma. Real disposable personal income. Extremely troubling is the precipitous drop in the real disposable income, which fell over $1 trillion in 2022. For context, this is the second largest percentage drop in real disposable income ever, behind only 1932, the worst year of the Great Depression. In a 70% consumption economy, this is as critical a chart as you need to see. Personal savings and revolving consumer credit spilling from that. The current expectation growth rate is sub 2%, with higher interest rates. This will be extracting a heavy tax on the economy. Therefore, why is the economy apparently running temporarily somewhat hot? The answer likely lies in the pandemic-related stimulus and the psychology of consumers. Both stimulus and irregular consumer behavior support extra growth. While the no-landing crowd likes to think the relatively high economic growth is substantial, we got news for them. This means supporting such strong economic growth is not likely to continue. The blue line shows that personal savings have fallen to a 12-year low. The growth of credit card debt has swelled to plus 25-year high. Unless wages spike higher, many consumers will cut back as savings deplete and credit card limits are reached. Further, higher interest rates on credit cards will reduce their spending ability. Again, we remind you, personal consumption accounts for nearly 70% of economic activity in the United States. Let's now consider the two lagging indicators that the vast amount of the present narrative appears to be built on. I believe in the latest Under the Lens video, this video, and recent newsletters, we have sufficiently bunked and placed them in their proper perspective. First, the non-farm payroll employment numbers saw 517,000 new jobs apparently created, an unheard of 8 sigma distortion, founded on new seasonal adjustments, apparent new population census numbers, the household survey versus normal establishment survey, as well as what the BLS describes as adjustments for international migrations, updated vital statistics, and improvements in estimation methodology, whatever all that means. I guess the manipulation can't get any clearer than this, and I suspect with such disclaimers, even the Inspector General could sign off on those numbers. The second is the unemployment rate. The BLS reported unemployment rate really did drop to record low, 3.4 from 3.6. It was, as Janet Yellen stated, again the quote, the lowest unemployment rate in 53 years. Even the Fed's former leaker, however, none other than the Wall Street Journal's original Fed whisperer, John Helsenrath, wrote in the Wall Street Journal, quote, demand for U.S. workers shows signs of slowing, long-anticipated development that is showing up in private sector job postings, even while the official government reports indicate the labor markets keeps running hot, end of quote. Making it pretty clear here, he was citing ZipRecruiting and Recruit Holdings, a parent company of Indeed, 2 large online recruiting companies, where Hilsenrath additionally notes that their data shows the number of job openings is declining more than the Labor Department reports on job openings. Before I leave this unemployment chart that Janet Yellen strongly echoed, I need to make another point. She fails to point out, as the dotted lines on this chart clearly demonstrate, when you plot her unemployment chart against the S&P 500, is that every time we have a low in the unemployment level, which we clearly have now, it consistently arrives with the top of the stock market, soon after which the market falls precipitously and the unemployment rate shoots up, also precipitously. You can't trade this as a timing instrument, but it is clear she is only telling a small part of the story, as only Janet Yellen so often likes to do. The message is clear. We are facing a broad array of what can only be termed the worst leading and coincident indicators in decades. We're staring down the gun barrel of an economic scenario that could be much worse than a normal run-of-the-mill recession. Yet because of completely disconnected, lagging labor numbers, the market is not falling and appears confused, complacent, yet cautiously optimistic of a possible soft landing. I think we need to recognize the masterful job the Federal Reserve, the BLS, and the U.S. Treasury Department have actually done. It has truly been something for the history books, but it has not been achieved by the sleight of hand through just simply data statistics. It is also being done in other stealth fashions in concert. There is another core driver to the market's seemingly indestructible resilience, which has made a mockery out of the chorus of sell-side strategists calling for a retest of the 2022 lows. What is going on is that despite repeat vows from the central banks that they are tightening, what we have seen in fact has been aggressive easing by the likes of the Treasury via the TGA account, which I wrote extensively on in our newsletters, the BOJ, and the People's Bank of China, which have cumulatively injected, not withdrawn, over $1 trillion in markets in the recent months. According to Citigroup's research, and I quote them, even as central banks have told us they're going to be tightening, it turns out that they've just added $1 trillion in liquidity over the last 3 months. In practice, they've been doing quantitative easing, even as they told us they were going to do quantitative tightening. That $1 trillion is directly worth about 10%, at least they calculate that much, in the global equities, or about 50 basis points off investment-grade credit spreads. I don't think it's a coincidence. That's almost exactly as much as we've rallied over the same period. The sources of this liquidity injection are a bit technical. There's a yield curve control intervention by the Bank of Japan. Then there was a deep drop in government deposits at the Fed, and especially at the ECB. And in December, the People's Bank of China did a major liquidity injection. End of quote. After years of market observations, I can say with relative certainty that price drives narrative. If prices go up or down, a consensus narrative soon emerges that supposedly explains what has happened. I can also say with relative certainty that often these consensus narratives are proved flawed. It is when this occurs that markets experience a rapid shock to badly mispriced trading levels. Stable to rising prices have fostered 4 market narratives. Earnings and strong labor market. Markets will rise when expectations for earnings and jobs rise. Inflation has peaked. Markets have weathered the storm and clear skies are ahead. A so-called no-landing scenario thanks to robust labor and consumer spending data and the strong performance of cyclical equities. China's reopening will be a major boost to the markets. All 4 are being peddled and seem to be being accepted. The business media is quite active in selling each of these scenarios. For all 4, however, the fundamentals are more complicated and face near-term tests. We are much more skeptical, as the market currently considers these. There are, however, some rules for discovering lagging indicator signals, other than from those being presented or massaged. They can give us some pretty good warning ideas, minus the distortions. I mentioned all of these in prior newsletters. For the sake of time, if you want more details, I suggest you go there. The takeaway here is that they are all currently indicating the lagging indicators in the way of unemployment and profits are all likely to be hitting major movements by June. It will be very hard by then to hide the reality of what's going on. Because the data, liquidity, and narrative games will have run their course, it is highly likely to come as a market reality shock. Breadth has been warning for some time now that a capitulation phase in this downturn, which started in January 2022, is likely to experience the capitulation stage of a bear market. Bear markets often exhibit a very distinct profile. Of course, there are never any guarantees nor consistency on the profile, but we haven't yet seen anything other than this that seems to make it pretty much like a classic bear market. The trick with all this is that markets normally lead. They price expectations out about 6 to 8 months. Sometimes this takes longer if there's a lot of confusion. There is certainly a lot of confusion presently, but I think this time it is a matter of the fear of missing out, or FOMO, that is at play. The markets are so conditioned to easy liquidity that they just can't accept reality without learning the lessons of a lifetime. Every generation does. The long-term charts certainly suggest it is time for a new generation to learn the truth about markets that future generations will remember until finally it fades away as the 1929 crash has now fallen away. This year's annual thesis paper clearly leads us to a conclusion that a beta drought decade is in front of us. However, never underestimate the powers to be ability to protect the status quo by changing the rules, laws, regulations, or whatever to achieve what they want. The current environment eerily reminds me of 2008. The way they fixed that problem was to change the derivative accounting at the banks from mark-to-market to mark-to-magic. The markets exploded from this, which was never divulged. It was all very secretive. And until recently, the markets have never looked back. Of course, mark-to-market have never been forced back on the banks. Games in off-balance sheet accounting, like contingent liabilities, may change credit creation dramatically, or more changes to derivative accountings may soon be in the wind. We'll never know for certain. But when they happen, the markets will take off until we can discover how they did it. Don't speculate. Let the markets tell you. Remember, the last 5% of the bottom 5% is always the most expensive. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take that money or it becomes of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has been traditionally been the true and tried approaches. Things are changing. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. And so until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.